Welcome back to Market on Close. Today's sell-off is particularly painful because on Friday we ended so strong with the end of the month, the rally to the high end of the range. Now we're below the low end. Kevin Green joining us here to put it in perspective. KG, so what a reversal there from the strength on Friday. How do we describe it?
Yeah, well, Friday we actually talked about it. We had a low liquidity type of market. You had end of month also taking place here. So pretty much after the University of Michigan data points, we did see a lack of trading take place. And so you can have these melt up scenarios as well as meltdown scenarios. And last Friday, we pretty much saw a gamma squeeze in the making here, ending us at the higher end of the range where we had positive gamma territory at around the 5650 level. And today we obviously are seeing a fade to the downside here. Now, this is not the position that you want to start off with when it comes to this week here, Oliver, because we are in negative gamma territory, not only when you're looking at volume, obviously, for today, but also when you're looking at open interest. And so what this chart is really showing us here is the new levels for the week. The first one that I would kind of focus on is obviously 5,500. Now, we might obviously, touch that level. If you kind of see this downtrend that we have on the left-hand side from last week, if we continue that, pretty much matches up right there with the 5,500 level. The 5,600 level now is going to be your intermediate area of support. That's where we could see some resistance. And then also keep in mind that 20 period moving average, which is sitting at around 55.53 right now. That number will be very important here in a few minutes. And then keeping that positive gamma area at 56.50. So we have a widening out of the bands. Unfortunately, the widening out is really happening on the downside end here. But when you're looking at the flows, you're not seeing, you saw some bearish activity happening with the puts this morning, obviously. But when you're looking at it right now, it's pretty much sitting right here at this level. 56.30 is really the key area. 55.30, I'm sorry, is really the key area to try to hold. And in fact, we just started seeing some flows going into the 55.25. So on an intraday basis, you kind of want to hold this here. For the rest of the week, 5,500 is going to be that key area where if we break through that, we have some pretty big problems here for the S&P 500 to start off the month.
So even though we are making on the index lower lows compared to last Wednesday, compared to the Thursday before that, does it seem like the options contracts are still kind of sticking around some of those ranges, or did like the whole regime shift downward today?
Yeah, you're seeing a whole regime shift. And actually, when you're looking at the longer term hedging activity that's taking place, looking at the October 11th expiration, you're seeing a lot of activity at the 5,100 level for the puts, as well as the 5,000 level. And so keep that in mind. Once again, we're just hedging. We know that we have a seasonally tough period when it comes to the S&P 500, but you're seeing a lot more bearish flows on the longer term time frame. And when we talk longer term, we're talking about a month out, 3 weeks out. We're not talking about a year or 2 years out, but you are seeing some hedging activity taking place right now. And then on the call side, some bullish activity, but not as aggressively as we would like to see here. So lopsided for sure. That's being reflected when it comes to the price action here. In this meltdown scenario, Oliver, it's not only just options flow in general. When we're looking at the S&P 500, we also are probably seeing a structural adjustment that's taking place when it comes to Nvidia. And it's not only just Nvidia, the stock, but when you're looking at the leveraged ETFs, the 1.5 times levered or the 2x levered, once you have individuals selling out of those, especially having 18% or 19% down days, you also have dealers that were long the Nvidia stock itself to be able to cover those swaps, also unwinding as well. I think that's also taking place. It's not just, oh, Nvidia is overvalued here. I think it's also a technical unwind or a mechanical unwind that's taking place, also pushing pressure down on the S&P 500.
Okay. KG, then 55 looks like technically also, an area, just the gappiness on the chart around there. And then to the point of that being that negative dealer level, I guess that's really got to hold, or else what? It's just all hell breaks loose?
Yeah, pretty much. And so when we talk about the negative dealer level for right now, we're already starting the week off in negative gamma territory. That negative level is sitting at the 5,600 level, technically 55.90. So we're already there, but we're highlighting a new area to kind of focus on here. And so, yeah, you get through that, then we have some pretty big problems here, because you start looking at gaps on the on the daily chart for the S&P 500. And if we're going to have some of those downside gaps that we saw in the run up, over 2 weeks ago starting to get filled, which 80% of the time they do, based on some industry metrics. If that's going to be the case, and you could have a rapid move to the downside, I don't think that's going to be. I think right now this is just an immediate sell-off taking place here, Oliver. And we have another chart I want to highlight here. And here's the reason why. The VVIX versus VIX relationship. We talked about this price ratio concept where the VVIX is measuring the volatility of the VIX itself, the VIX options, and then the VIX is obviously measuring the volatility of the SPX options. And what we actually see for today, with that line going up, that red line kind of going up, that means that VVIX is actually moving higher or moving quicker than the actual VIX itself. Traditionally, we don't see that on these major sell-off type of moves. We actually saw that event that we had last month. You could see that the VIX was actually moving higher than the implied volatility of the VIX itself. And so I know that's kind of an interesting concept, but let's just say this. You have dealers and you have institutions right now hedging and utilizing VIX options in order to hedge, but they're not so much going heavily into the SPX options yet. And until we actually see a domino effect or this massive interest in trying to buy puts on the SPX itself, that's when you're going to get a little bit cautious. A 20 VIX right now is nothing to scoff at, but it's not. We're not at danger levels yet. And so if we're going to see this kind of develop here, you actually want to see that red line move to the downside, where you actually have the VIX spiking faster than the VVIX itself. That kind of tells you, okay, the market's actually bracing for something bigger than what we might be pricing in for right now. And you do have a favorable ISM services print that will be coming out, I believe, tomorrow, because tomorrow's Wednesday. So ISM services actually does fare a lot better than ISM manufacturing, and it's 70% of our economy. When you're looking at the services number, a favorable print there can turn the tides, just like we saw a favorable print last month turn the tides when it came to that those sentiment indicators.
Got you. Nice. Thursday, the services, but yeah, totally. All right. Friday, obviously employment. So the VIX versus VVIX is kind of interesting too, because that to some degree is kind of like normalized a little bit with the way VVIX had spiked so much. In that context, that's kind of what we were talking about earlier with Kevin. Throughout the context of the last couple of weeks, the vols remained higher. So when you kind of put this into perspective with the giant sell-off that we got around employment, kind of makes sense then that VIX should perk up a little bit, kind of get in line with the VVIX as we head into the next employment report.
Exactly. So you're talking about the distance less traveled. So the VVIX really, it came down since that August spike, but it didn't come down as dramatically as the VIX did itself. So that's what we are highlighting here. Yes, you're still seeing a situation here where implied volatility for the VIX itself is relatively elevated. But if you're looking at the volatility index, the VIX itself, the move that we have here today, Oliver, down 2.3%. I think this would actually be the second time this year that we would have a 2% down day. That would actually warrant us to actually have around a 32 to a 35 VIX implied vol in the market, and we just don't have that yet. So it's being reflected in the VIX options, but it's not being reflected in the SPX yet. Now, that could actually happen. We are seeing a dramatic move to the downside here. If we can go to the volume chart here real quick for today, you are seeing a breakdown in this market. 55.30 did actually fail. 55.25 failed. And it looks like we're on the trajectory to try to hit 5,500. Let's see if some buying activity is going to take place there, because we are really overstretched when you're looking at convexity, or basically when you're looking at that the bearishness in the market. Usually you kind of see a reversion or a mean reversion going into the close here, and that's what I will be looking at for the next 20 minutes or so.
All right, great stuff. We are hurting and fading as we speak, Mr. Green. So an ugly session here. Thanks for the perspective. Great stuff. Like to look at vol too. Appreciate it, Kevin Green.